Good evening, everyone. So I was just going to do a bit of an intro to the Alliance Trust, for those of you that don't know anything about it. Normally I stand up here and go on about how long the Trust has been in play, since 1888, 130 years, but I'm just following F&C that was about 160 years or something like that. So we're just a child relative to F&C at 130 years old. But importantly, it's been completely reinvented very recently to be appropriate for the new generations of savers going forward. So following a full strategic review, Willis Towers Watson, I'm the Chief Investment Officer at Willis Towers Watson, took over as the investment manager of the Trust on the 1st of April 2017 when they sold off their internal asset manager at that time. And we were brought in to bring a whole new approach. Yes, a multi-manager approach. There are other multi-manager approaches out there, and you've just heard from one. But this one has got a bit of a different take on how it goes about things. And it's something that we've been doing in the institutional space for quite some time and have brought to the UK retail space for the first time recently. And I'll go into that in a bit more detail. So, the first obvious question, I think, is who the hell are Willis Towers Watson? Probably not that well known in UK retail space. Actually, incredibly well known in the institutional space. So, we advise about $3 trillion of assets in institutional space. Our typical clients are corporate pension plans, sovereign wealth funds, insurance companies, large endowments and foundations, typically hundreds of millions or billions, some hundreds of billions in size. We manage on a discretionary basis, on a multi-manager basis, as we do with Alliance Trust, 130 billion of assets for institutional clients. So this is something that we've been doing for many, many years, but haven't been doing in the retail space, and that's really what the partnership with Alliance Trust allowed from about 3 years ago. But the main reason for putting this slide up is to show that I don't normally look quite so hairy. This is very much a December thing, even though it's November, so that I can look like Santa for my kids, although it's annoying me so much I think it could go tomorrow. I think the key thing I would say is that what we've seen in recent years from institutional clients is that a lot of them, having had many years of struggling to get much outperformance from their active managers in equities, have started to see it as just a very expensive way of running money. We've been talking to them about, well, maybe there's a different way of structuring the way you invest with managers in equity space that gives you a structural advantage over the typical way of investing with managers. And that's what we've tried to bring to the Alliance Trust. So what on earth is this different approach that I'm talking about? Well, there's kind of 6 pillars to it that we've got up here. So the first thing is high conviction. And so what we've got in the Alliance Trust is 9 managers who each run very, very concentrated portfolios, so maximum of 10 to 20 stocks that they can invest in. So it's a separate account run just for Alliance Trust and Willis Towers Watson. You can't access that through their mainstream products. So why do we do that? Well, we started doing this more than 10 years ago with a few institutional clients. It's produced exceptional results. But interesting, there's a lot of academic research that's been done out there. And there are 10, 15 papers that have focused specifically on this topic and come to the same conclusion. But a good one, the Sebastian and Ataluri paper, actually did some analysis that said, let's take every equity manager in the world, let's look at how much risk they take relative to the benchmark. They then ranked them into deciles of how much risk they take relative to the benchmark. So on the far left-hand side of the chart, if you can imagine it, you had people that are closet index trackers, really don't take much difference from the benchmark, lots of stocks in their portfolio. On the far right-hand side of the diagram, you'd have people that run these 10, 20 stock portfolios. Think about risk in terms of permanent loss of capital. Think long-term. Don't worry about risk relative to a peer group or a specific index benchmark. And what you see is that if you randomly throw darts to choose the people that run the 10, 20 stock portfolios, you will outperform by about 1 to 1.5% per annum versus randomly throwing darts at people that run the diversified portfolios. And yet diversified portfolios are what you find in pretty much everything you can get in UK retail space. And that's not surprising. The reason that happens is actually that whilst most managers, well, half of managers outperform before fees, half of managers underperform before fees relative to the index. That's by definition. That's what the index is made up of, all of the investors. Interestingly, though, the majority of managers outperform in their largest 10 to 20 overweight positions and then destroy value in the rest of the portfolio. Not every single manager, but on average, that's what tends to happen. And that's because human portfolio managers can have 10 or 20 great ideas maybe in their head, and that's how they would like to run the money. It's how they run their own PA money typically. But their risk team would say, or their business team would say, you can't do that. You're going to have ridiculously volatile performance. You're going to get fired at exactly the wrong time. And so they put in portfolio fillers to bring the risk down. Now, they think those portfolio fillers are going to have no real impact on the return. They'll be neutral. They might just dampen the level of outperformance. But what actually happens is that they destroy value. And that's because, by definition, the things you put in for risk control purposes are the ones that are the largest stock in the benchmark, which are the ones that have gone up the most, which is an anti-value bet, which over the long term destroys value. And so the principle that we took in the institutional space was, why don't we just find some great stock pickers, tell them we only want their 10, 20 best ideas. Don't worry about risk relative to peer group or benchmark. We'll worry about that in how we blend the managers together. You just give me your best ideas. And then you end up with a diversified portfolio because you've got a number of managers together, but each stock that's in that portfolio is someone's very best idea. There's nothing in there purely for the purposes of risk control. But the risk control comes in how we choose the managers that think very differently, how we blend those managers, such that you end up where we can actually take out pretty much the macro risks, so we can make it look like the benchmark in geographical terms, in sector terms, in style terms, so you haven't got to bet on a growth manager or a value manager or an income bias or anything like that. Looks pretty similar to the benchmark at the top-down level. And yet it looks nothing like the benchmark at a stock selection level because they're not worried about relative risk and benchmark risk, so they're not just buying the big stocks that you see in all the other portfolios. And so you just get this structurally better designed portfolio that tends to add value, backed up by the academic evidence and backed up by the decade-plus experience we've had in the institutional space. So that was the principle of what we brought to it. But of course, why Willis Towers Watson to do that other than the fact that we've been following this approach for a decade or so? Well, it's because we've got this advantage of a few trillion assets under advice that we've grown a very large research team. So we have one of the largest research teams in the world that go out and research investment managers. Over 100 people, that's all they do. They just go and find who are the best stock pickers, no matter where they're located, anywhere in the world. And then within that, who are the ones that are best at running these concentrated portfolios. We can do that within the Alliance Trust concept, continuing this 52 years of growing dividends that the Alliance Trust has been doing. And I'll touch on that later as to the impact that can have. Importantly, and I'll spend some time on this in a bit, on the sustainable front, we think increasingly sustainability factors, and in particular the impacts of climate change, are going to really influence stock prices far more than is embedded in the thinking in the asset management industry today. And so we've done quite a lot on that to give us a real edge, we think, when thinking about long-term expected returns in this portfolio. And finally, we can do that at much lower cost than the typical multi-manager approach. If you look at multi-manager approaches where there is no internal managers and they just have external managers, the average costs come out at 1.3% per annum in retail space. This is at half that, at 0.65% per annum, with all of it externally managed. So our team can whittle down 16,000 to 17,000 equity managers that we research, go through the funnel of all the research we do to come up with about 20 or so really high quality, truly global equity managers that we think are skilled at running these 20 stock maximum type portfolios. And from that, we pick somewhere between 8 and 10 that make up the Alliance Trust portfolio. Today it's 9, it was 8 when we started. And this gives you a real advantage over both a single manager approach, lots of the things that you heard before, that you don't get wedded to a single style, the skills of one individual. That really is a big advantage to going multi-manager. But typically the disadvantage of going multi-manager are that either it ends up being far too expensive, or it becomes just so diversified that you look too similar to the index and it's difficult to outperform. Well, we've addressed both of those things. We have the advantage of being able to get the costs so low because we're negotiating on behalf of a few trillion of assets rather than just the 3 billion that make up Alliance Trust. These are the 9 managers that make up the portfolio today. I suspect some of you in the audience will know the bottom 3 probably more than the others. Those are the UK-based asset managers. 5 of these you can only get access to in UK retail space via Alliance Trust. All 9 of them, the only way you can get access to their best ideas portfolio is through Alliance Trust. Any portfolio that you would get through them any other way is their more diversified portfolio. So this shows you what I'm talking about with why you wouldn't necessarily want to just hire one of these 20 stock portfolios. They're incredibly volatile. Some of the managers over the 2 and a bit years that we've been doing this have outperformed by 25% over that period. Some have underperformed by close to 20%. Now, not surprisingly, at the bottom in this period, you've got some of the more value-oriented managers who have struggled. And at the top, you've got some of the more growth-oriented managers who have had a tailwind to their strategy. What we're trying to do, and it's done on your behalf when you invest in this, is try and understand what are the reasons that the managers have been struggling at the bottom. How much of that has been their skill or lack of it? How much of it has been just unlucky because their style has been out of favour? And so we're trying to understand, and we check as we go through. We have each of the managers regularly give us their forecast for earnings growth from all of the companies they're invested in, and so we can track how that does relative to what they were expecting, and we can understand how much of the underperformance in their stocks has come from them calling the fundamentals in the company badly, i.e. they thought the company was going to do better in their operations than they did, versus actually they called that perfectly well, but the market, for whatever reason, has increased the multiple on stocks in that particular area of the market. If it's more the latter, we'd actually be taking money away from the managers that have performed particularly well and rebalancing and giving it to the ones that have done poorly. If it's more that they're starting to call the fundamentals wrong, then you're questioning whether you want to give more money to that manager. Indeed, you might want to replace that manager. To date, we haven't had to do that, but we're only 2 years into this approach specifically for Alliance Trust. We've obviously done that with our other portfolios that we've been doing for a lot longer. I won't go through all of these slides. They could become a little uninteresting if we go on forever. So I'll just take you to what it looks like in a stock perspective, because interestingly, you really don't get huge overweight positions in individual stocks. So when you think about it, they're running up to 20 stock portfolios. There's 9 managers, and then there is one emerging market portfolio that can run a few more. You get just under 200 stocks in the portfolio. 185 of those stocks are only owned by one of the managers. So this is not you just getting massive overlap and you're getting a diversified portfolio that's quite expensive and you're ending up looking like the benchmark. It really looks nothing like the benchmark. But equally, it's not completely dominated by 4 or 5 stocks. If you actually saw the list of stocks outside of the top 10, they haven't actually got a lot lower weightings to them, and they won't necessarily be stocks that you've heard of or you're seeing in other trusts very often. As you can imagine, if you've got a universe of a few thousand, you're told just give me your best 20 ideas and don't worry about the benchmark. You're not typically going to come up with the largest stocks in the index. This is just a reminder of how important dividends are. This is giving you a feel for what's happened in Alliance Trust over the 52 years. So these bars here are the growing dividends that we've had every year, dividend per share on the right-hand scale. On the left-hand scale, this is the return you would have got on the capital return on the trust, and then when you include income, just a reminder of how compound interest works, the difference between a sort of 7.5% per annum return and a 10.5% per annum return. So just to finish on the sustainability piece of things, I said this in our mind is becoming more and more important. And within that, we think climate change is going to be the most important piece of the whole pie. And this is not a claim that we're wanting to do anything for moral grounds or ethical grounds. That is a benefit to doing it as well. But this is actually on a pure financial grounds. We think there are good reasons to run a more sustainable portfolio, and particularly in the climate change area. So you've got the Paris Accord, you've got all of the pledges that are coming out of the various parties as part of the general election on the approach that they're going to follow on cutting carbon emissions and the like to be in line with the Paris Accord and other initiatives that are being put in place. If all of that happens, if we get any kind of carbon price that comes in, which if there was a sensible carbon price today, it would be $100, $200 rather than the numbers people have put into spreadsheets to look at what the price of various companies should be in that environment, you will see some very, very different outcomes from companies than are currently priced in. And so we think this is absolutely critical when you're running a long-term trust like Alliance Trust. So we take three key approaches to this, three lines of defence to the risks from sustainability. The first is that we do a lot of research specifically on the managers, on their ability to integrate all of these ESG factors into their approach. Every investment manager can give you a good ESG policy that's nicely written down, that's been written by their central sustainability team. But if you actually go and spend time with the analysts and the portfolio managers, in many cases, they're not really taking any of that into account when looking at the company. So that's a big part of our research process. And typically, when we're researching an investment manager, we might spend a typical meeting 2 or 3 hours with the manager, with the analysts and the portfolio managers. And we might do somewhere between 10 and 50 meetings with managers before we get comfortable with them to put that in perspective, and some of those meetings are focusing just on these ESG parts of their process. So that's the first thing we do. And so the managers have to be good enough to get into the portfolio on that front. The second thing we do, as I said, is focus on climate in particular. And so we start monitoring on an ongoing basis, what does the portfolio look like in terms of carbon emissions, carbon intensity, and percentage in stranded assets and fossil fuels more generally? How does that look in absolute terms and relative to the benchmark? And so if we did get something like a carbon price coming in tomorrow, what would that mean for us? Are we overweight or underweight that significant risk in the portfolio? And that's a big part of what we do on an ongoing basis. And again, the advantage of our large team is that we can afford to get a lot of those data analytics to spread across our wider institutional client base as well as Alliance Trust. And then the third thing we've done is that we employ Hermes equity ownership services, who are about the largest engagement overlay service in the world. Of the Climate 100 initiative. I don't know how many people have heard of the Climate 100 initiative, but this is where a group of very large investors around the world have got together to put pressure on the 100 largest carbon emitters in the world, companies that are the largest carbon emitters in the world, put pressure on them to try and get more in line with the Paris Accord and what we'd expect from them if they were going to do exactly that. And Hermes lead on 27 of those 100 initiatives, more than any other group in the world. And so what we ask them to do is to engage with all of the companies in the portfolio on our behalf. So to give this a bit of a feel for you, in the third quarter, they engaged with 42 companies that were in the Alliance Trust portfolio. And we're going through all of the ESG and strategy issues that would be best practice with each of those companies. And they've made significant changes at some of the largest companies in the world, working with other investors, but typically they would be leading on many of those initiatives. What they also do is they make proposals to each of the 9 managers that are in Alliance Trust as to how they think they should vote on each of the issues that are coming up at the companies they're invested in, if they were to be best practice in E, S, and G. Now, those managers can choose to vote differently to those proposals, but if they do, they have to justify to us why they're voting differently. And sometimes there's good reason, but that allows us again to really understand whether they've got the credentials to be best in class in the sustainability area. So that's the end of the slides I'm going to go through. Obviously, we can get to some questions later, but I just wanted to try and bring out those differences. Multi-manager approach, but done very differently with separate accounts, highly concentrated, and with a long-term bias that means sustainability becomes more and more important in their portfolio. Thank you.